Hello everyone, welcome back to the channel, best place for long-term stock investors. Now, in this video, we're going to be discussing how to invest in 2023. We know that there's a lot of uncertainty and a lot of investors are actually pretty clueless in the market. They don't know what to do in this sort of environment. But don't worry, we'll be sharing with you our thoughts on this video. So stay tuned. As a disclaimer, none of what we say should be taken as financial advice. This is purely educational. As another disclaimer, we do own some shares mentioned in the slides.
Hey guys, before we begin, just to let you know, we have a totally free masterclass just for you to sign up for in the comment section or the description, where we will guide you on how you can build a 6 to 7 figure portfolio using the power of stock investing. Go check it out.
Okay, MJ, so how do investors anticipate 2023?
Yeah, so before I go on, what I'm about to share with you in this video is actually just a tiny snippet of a webinar, a full-on webinar, like almost an hour and a half that we did last Thursday. Many people wanted a replay because we typically don't give replays, but they asked for it, so we've decided to open it up as well. So do check it out. You can hop onto the webinar through the comment section or the description. Okay, so anyway, this way of investing that I shared in the webinar is what has it given me? Number one, when most people's portfolio were bleeding in 2022, I managed to avoid the majority of the downturn because of some of the techniques that I use in this FIRL system. And of course, some of these stocks were also discovered, and I also invested in some of them based on this FIRL system that I shared in the webinar. So do head over to check it out. So this FIRL system is basically split into three, right? You got timing, education, and research. The key thing is that you never want to skip any one of them. So to give you a point, let's say if you skip research, then a lot of what you do will be pointless because you won't be able to find the right stocks.
Yes.
Right? Now, let's say if you skip education, that's also very dangerous because maybe you can find the right stocks and your timing is quote unquote good. But without proper education, you will not be able to manage some of the risk and the volatility that you'll likely experience. And if, let's say, you ignore timing, you can find good stocks, you manage your risk well. That is probably the best out of the other two compared to the other two. But you will need to have lots of patience because if you don't time the thing right, even if you find the right stock, it might take years or maybe a lot of months before you can see your investment play out. So essentially, this is what we call the FIRL system. Now, the first step, which is timing, is essentially about figuring out where the wind is blowing. That's really, really important. And where is 2023 heading, essentially? Now, why is it important is because far too many people in the stock market, especially if you've read books, if you have, read reports, and you're the type of investor, you love to understand companies and things like that, which we are, you are essentially trying to figure out how good the ship is, right? What type of wood is it made out of? The sail, and then also the captain behind the ship. And all this are absolutely important, right? If you want to reach your destination using a ship. Now, if you haven't noticed, this analogy is that the ship is a stock, right? Okay. But even if you found the best captain or sailor, the best ship with all the best ingredients, the best cannons, whatnot, if there's no wind, it's not going to move. Now, the beauty of having a great ship is that it's high quality and it'll be around. But it may be stuck there if there's no wind. And so, essentially, the first step of timing is to figure out what this wind is. So, why or how I would associate the wind with, or what I would associate the wind with, is actually this thing called macroeconomics. Okay, it's a fancy word, and it sounds very big and daunting, but essentially it's this specific to the stock market. We know the stock market goes up by earnings. So if earnings grow, or if earnings weren't as bad as anticipated, we know the stock market will respond positively. And the reverse is also true, right? If earnings drop or drop more than expected, the stock market will react negatively.
Yeah.
So the question is, what causes earnings? A lot of it, in fact, all of it is caused by GDP. If GDP is reportedly good, then earnings will also be good, right? That's typically what we call a time lag.
Yeah.
So the big questions to you as investors is not to figure out precisely what the earnings are or what the GDP is, but what drives GDP. That's absolutely key. Because when you figure out what drives GDP and you can be early compared to other investors, then you will know the GDP, you will know the earnings, and then of course you will get a positive result with the stock market. Okay? So the way we look at what we call GDP drivers is essentially this thing called leading indicators. Okay? Now, a leading indicator just tells you what is, as the name suggests, what leads some things that might happen, like GDP, earnings, or payroll, or inflation, which are what we call coincident and lagging indicators. So coincident indicator tells you what's happening right now. A lagging indicator just tells you what has happened long ago already. But leading indicator tells you what is about to happen. And as an investor, you want to be in that position. So to give you a case, right? Unemployment is a classic example of a lagging indicator.
Yep.
Right? Because it has already happened.
Yes.
For unemployment to happen, what has to happen? Earnings have to drop. Things have to be bad. Right? So earnings is a coincident indicator, more like a coincident indicator. Sometimes they can be in both, right? So if you figure out beforehand, like how is the business doing, let's say, which we will go on a little bit later on. How is the business doing? Some of the qualitative factors. What are the orders coming in? Then you can figure out how are earnings going to be affected, which then you can see down the road, maybe 1 year down the road, that unemployment is going to happen. So you're ahead of most investors. All right, guys, if you didn't know, we have a one-on-one mentorship program where you can apply for, where we level up your stock investing based on tailor-made solutions. If you're interested, you need to apply. Not all of you all will get into an interview. It's only 20% of you all will do it, and even fewer will get to hop on the program. But if you're confident that you can qualify, you can click on the link and fill in your details in the comment section or the description.
So MJ, you mentioned leading indicators. Can you give us an example of what is a leading indicator?
So one of my favorite ones is this thing called the PMI.
Okay.
Or the Purchasing Managers Index. Now, I actually mentioned 3 different leading indicators in the webinar.
All right.
Again, in the comments or the description.
Yeah.
And one of those other metrics actually helps with predicting recessions very, very accurately. So if you're interested, go check it out. But let's talk about the PMI or the Purchasing Managers Index, right? Essentially, this is a survey done by 300 of the largest manufacturing companies in the US. Let's focus on the US right now, right? And it's broken down into 5 different components: new orders, production, employment, delivery, and inventories. So when we say things like employment, right, it's not how many people they have employed. It's how many people do you plan to employ. So as you can see, the survey consists of questions, right, that are leading, right? What are you about to do? So the 2 big components I typically focus on here is new orders and inventories. So new orders will tell you, hey, is your customer, ordering stuff.
Yeah.
And inventories is how much of those stuff are you stocking up in anticipation of future orders. So as you can imagine, if new orders go up and inventories go up, it's fantastic. So why is the PMI a great tool? Is because for me, it's a pretty decent prediction tool. Now, the PMI is roughly 85% correlated with GDP with probably a maximum of 12 months time lag. Sometimes can be 9, sometimes can be 6. It all depends. So what does this mean? It means that 85% of the time, if the PMI goes up, the GDP goes up. Vice versa. If it goes down, it goes down. If it's flat, it's flat, right? So then you have a correlation between GDP and S&P 500. So the GDP has anywhere between 67 to 93% correlation with the S&P 500. So GDP goes up, S&P 500 also goes up at a minimum of 67%. Okay, now there's a lot of math and stats involved. Let me translate it for you all. It means that 6 out of 8 times, right, or 6 to 8 times out of 10 investments, if you get the PMI right, you will get the S&P 500 right. So that's how useful it is, because that's why they call it a leading indicator, right? There's a 12 months time lag ahead of time. You already know what's going to happen with the stock market.
Right. Okay.
So before I show you exactly how I use the PMI, some basics are in order. To read the PMI chart, right, you need to actually know that if it's above 50, it means it's growing. If it's below 50, it means that the business mood, let's call it, is contracting. Right? If you think about it, these 5 questions that they ask these manufacturing companies is a mood question. What is your mood about the orders? What's your mood? Do you feel like, right?
Yeah.
Now, and that's why it's never 100%, because it's just a mood or feeling or sense. And that's why the correlation, as you can see, is 67 to 93%. Right? It's not 100% accurate, but it's pretty accurate.
Yep.
Right? So if let's say it's above 50, it is growing, below 50, contracting. But sometimes you can drop from, let's say, 55 to 51. You are still growing, but the growth is slowing. Vice versa, you can be at 42 and there's a big contraction. But let's say it goes from 42 to 48, you are contracting slower. Right? You're going back towards 50. So how I managed to avoid the 2022 downturn as far as protecting my portfolio is that I saw in March 2021 as the peak, right? So I'm here in roughly 2021.
Yep.
End of 2021. You can see the growth is slowing really. And you can see if you had that data, what it told me is that, okay, look, what used to be a pretty bullish market, bullish businesses are now going to scale back. And so the S&P 500, of which the top guys, right, are mostly in the high growth, high tech sector, your Metas and your Teslas of this world, will be the first to get hit.
Right.
You could have figured that out beforehand based on just one chart. Okay. And as you can see, the S&P 500 is pretty down. Now, this was recorded, I believe, in August. So it looks decent, but I can assure you.
Yeah, it's down even more.
Yeah, it's down even more right now. So this is how I managed to glimpse into the future a bit. Again, did I know it's going to fall by this much? Did I know when it's going to fall? I don't know. But I was looking at it in November and I was pretty fortunate that the peak was in December. That's it. The peak could have been in February. You never know.
Yep.
But the basic idea is that it just gives you a sense that roughly this is the direction.
It's like a heads up for you to prepare yourself.
Correct. And as Warren Buffett always say, you don't need to know the weight of a person to know he's fat. Right?
Yep.
You need to be roughly right rather than precisely wrong. So specifically for Malaysia, I like to look at the Taiwan PMI. Right? So some tidbits for you guys. You guys don't want to watch the webinar, it's fine. This is one big tidbit I can share with you all. Taiwan's PMI is important to Malaysia because, as you probably know, Penang, the tech hub of Malaysia, has a lot of links with Taiwan. Yes. They depend on Taiwan, right? And even if they are not selling to Taiwan or anything, figuring out what's happening in Taiwan will tell you a lot about the world. To give you a case, if TSMC has decided to stop spending money,
that's a bad sign.
Wouldn't someone like okay, I mean, in this case now, Samsung is actually spending a lot of money even though TSMC is scaling back, but that's because they already promised to spend 2-3 years before that, and it's a bit different. But look, if TSMC is sensing a slowdown in the economy, don't you think, a slowdown in their sector, don't you think that the other guys like Intel and all that will feel the same way, right? So what does this mean? It means that it will then tell you, Mr. Malaysian investor, that maybe semiconductors are not going to do very well. So you can see here, early 2021, the decline was already very massive. Now, the key is you don't have to wait until the contraction starts to appear, right? Above 50, you can already have enough information to say, no, it's not going to do very well. So right now, looking forward, it has already broken past 50 in 2022 and is at the low, which is the last time it was this low was 2008, 2009, right? Now, another thing I like about the PMI is that it likes to give you a lot of these comments on what's happening from the business owners and, of course, the analyst himself. And so you can see here are some of the comments that I put out. And this you can find in IHS Markit, which is a S&P Global affiliated company. So output and new orders are falling. And again, remember I said earlier, new orders, absolutely crucial, right? So new orders, not going to do well. Troubles for Taiwanese manufacturing sector, the PMI dropping the lowest since 2009. And manufacturing firms in Taiwan substantially cut back on their purchasing activity. So you can know also that inventories are going to drop for Taiwan already.
Yeah.
Right?
Yeah.
So all this has a ripple effect into Malaysia. If Taiwanese companies don't spend, Malaysian companies won't be able to provide their services. And it's going to be not so fun.
Yeah.
Right? But you might be asking, like, okay, but this is manufacturing, what does it have to do with semiconductors? Well, true. But you can go and check Taiwan's economy. A lot of them are linked to semiconductors. And so it's, in a way, it's a proxy to the semiconductor.
Yeah, it's like what you explained in the webinar.
Yes.
The Saudi Arabian is kind of a proxy of to the oil.
Yeah, I mean, Saudi Arabia did invest in Uber.
Yeah.
But really, they are proxy to oil.
Yeah, yeah. So, okay, I believe you guys also would definitely benefit a lot from this PMI sharing itself. It's only one of the 3 leading indicators. Yes. So if you want to know all 3 of it, head on to our webinar. Yes. The links are all in the description. In the next segment, we're going to be talking about which sector you should be looking at.
Yeah. If you're enjoying the video so far, remember to like, comment, subscribe, click on the notification bell so that whenever new videos pop, you know it fresh. Okay, so Jonathan is going to guide you through step 2 and step 3. Don't worry, it's a lot shorter than step 1.
Yeah.
So step 2 will be the kind of stocks that you want to find.
Yeah, but specifically, which sector are they actually in?
Correct. So before we talk about specific stocks, so you can imagine, right, step 1 was big picture, right? The macro environment. Step 2 will be more the sectors. So go ahead.
Yeah, okay. So this is an example that I gave during the webinar. Basically, the point of me trying to prove you guys right is that not every depressed sector that, let's say we are in a recession right now, all sectors are down, but not all sectors that are down will rebound back in the future, because you never know whether the demand for that particular sector will actually revive, whether is there even still business for this kind of sector, all right? So the first example that I actually gave was the evolution of media, because when was the last time you actually have like a radio, like a physical radio in your house? I mean, maybe you keep it as like a, I don't know, like as a memory or as a souvenir. But if you do store it, then that's great. But we don't really often use radios right now in our house. I mean, we do hear radios in a car, or maybe now we watch social medias, TikTok, Facebook, and that's how we actually get the latest news and everything. So that is basically what is happening to the media side of things. A lot of people are not really using traditional media as much as it used to be before. Now everything is all online. Now, the second example that I gave was this thing that people usually go out to physical stores and purchase stuff. I mean, now also we kind of still do, but now we have the option to actually not go out. We can actually order stuff online. We can call Grab Food to order our food. We can even call Shopee and then they will deliver it into our house. Yeah, so that's how convenient it is right now living in 2022. A lot of things that is traditionally practiced is not really, we are not really doing that right now. Yeah, everything is changing. There's a shift in technological innovation, and hence we are seeing all of these changes, and which is why also certain sectors which are in the traditional space will not rebound in the future or even now. Now, the last sector that I actually shared was everybody is going cashless. Yeah, I mean, this is actually pretty much evident if you compare between 2017 and 2022. Now, I gave an example of this particular company called Revenue Group Berhad. So, Revenue Group was IPO'd in 2017.
Yep.
But back then, 2017, not many people actually understand how important it is digital cash is going to be in the future. So in 2017, I believe the stock was doing okay, but it was not really going up like it is exponentially. So because people still thought that, we still need cash. We still need cash to transact. But looking forward, now in 2022, Revenue Group Berhad has actually more than 5x its market value. Why? As evident, we're now using a lot of online payment style. We use touch and go e-wallet, we're using Do It Now. A lot of things are actually going online, and we are going ahead into a cashless society. And that is one of the way you can actually generate ideas, which is to actually discover companies that is adapting to all of these changes and actually investing in innovation to improve their tech. Yeah. So that is actually the glimpse of what I share in step 2, which is find a sector that is actually growing and is in demand.
And there's a checklist that you have, right?
Yes, things to correct. Okay, so after you know about step 2, now it comes to step 3, which is actually I talk about in the webinar in detail. I gave 3 points. So total addressable market is one of the 3 points. If you want to know the 2 points, watch our webinar. The links are all in the description and comments. So to keep it simple, right, for total addressable market, this point is that not every company can actually grow in terms of capturing market share, in terms of growing their revenue. So that's why you have these 3 types of TAM, or total addressable market. TAM is for short. So the first TAM is basically the shrinking TAM. Basically, these are the type of company that is unable to capture more market share. But in fact, they are actually reducing market share because of
the entire market itself. It's shrinking.
Yeah, it's shrinking. Yes, correct. And hence, they cannot really generate much revenue. And this is pretty much evident in Parkson's case. So if you look at Parkson's financial statement, right, you know that their revenue is actually doing quite bad. The reason why is because they cannot adapt to technological changes. They don't really have much presence in online. They are more still tied up in the traditional phase. They want people to go to their physical store to shop there. So that is why you can see that their revenue is actually not doing that well. Now, the second TAM is actually the stagnant TAM. So that is a company that it's a necessity, but they cannot really capture more market share. They cannot grow their revenue. So for instance, like Spritzer, everybody needs water, but how can you innovate water? Yeah. So it's what it is. It cannot grow even further. Now, the TAM that you actually need to look at as an investor is that a TAM that is growing. So the example that I gave was Revenue Group Berhad. Why their TAM is growing is because everybody is going towards a cashless society right now. Everything is going digitalized. So that means Revenue Group Berhad's revenue will also increase because of this shift in industry or shift in technological changes. And that actually benefited the company a lot. You can compare between their IPO and the current market value of the company right now. It has actually grown more than 5 times. So this is actually one of the many ways you can actually analyze which stock to actually pick from. Yeah. So
how you can manage your risk this is a very risky thing, right? If you invest in a Parkson or whatever, you have the risk of not just shrinking the TAM, shrinking your profits.
Yes, and shrinking your share price.
And when it comes to Spritzer, something very similar, right?
Yes.
It's not going anywhere.
Yep. Okay, I think that's about today's video. If you want the whole full length of our webinar, make sure to check it out. Everything, the links are all in the description and comments. And also, please do take note, we're going to be taking out these recordings on the 10th of November. So after the 10th of November, you won't be able to see this recording. So if you want to check it out, make sure to go to the links right now. Right? Okay, so I hope that you guys benefited in today's video. Do you have any last things to
No,
add
guys, look, the year is about to end.
Yep.
So looking forward to seeing you guys in 2023 as well. It's a bit early to say this, I feel.
But
still 6 months. But guys, prepare yourself, right? Prepare yourself. Do what we always do, right? Which is have a inventory of ideas, a gravy train or manufacturing conveyor belt of ideas, because when things go bad, when things starts to look even cheaper with a recession, you know what to do immediately. Don't try to just wait and predict for a recession. Even if you get it right, okay, what are you going to buy? I always tell people who predict recessions, okay, what are you going to buy? Where's your process for that? If you are a serious investor, you need to head on to this webinar. And guys, with that, signing out.